Kiril, 18 months since we actually got together on camera and started to talk about things, and I've been thinking of something that I'm seeing in the data and the research that I'm looking at that I really want to pick your brains on, because I really respect how you think about things. And so my hypothesis is that we're looking potentially likely to be going into recession. I think the global situation is more concerning than most people think it is. Even today, we've had Jerome Powell indicating that they're going to cut rates, but nobody really believes that maybe the cycle's ended. And I really think it is, but I wanted to know, what are you thinking?
Well, the great question of our time is whether this is a mid-cycle correction like 95 or 98 with the Fed easing into a recovery, or whether it's recession like 1989, 2001, or 2007. And I have a very hard time seeing that this is 95, and I can go into why I don't think it is. I'm totally agnostic. I'll let the market decide for me. But all the evidence on economic data and above all, confidence and trust, because this is really a confidence and trust issue. How are you going to put confidence and trust back into the picture? You've done a savage cutting on that. I cannot believe it's possible for trust to be restored in the next year and a half. Just impossible.
So how do you rebuild trust?
It takes years, decades. It's extremely significant.
So your sense is that we may be at a cyclical turning point, but we're actually this is a secular turning point as well in many respects.
It could be. If the U.S. goes for protectionism and the rest of the world were to follow, it definitely would be a secular turning point. If the U.S. goes for protectionism and the rest of the world doesn't follow, it won't be quite as bad. But then you have the whole cycle of wealth distribution coming, and how's that going to play out? And if Trump doesn't get reelected, what then happens to all of the deregulation and tax cut, all the things that he did to get the stock market up? Will buybacks be outlawed? I mean, there's so many things that could happen that are a significant watershed event that the market isn't paying any attention to, but is a significant risk. And then, of course, you have what I call the burden of the debt, which might be the reason why it's so hard to get growth. And the last time we tried to do economic growth with more debt, solving the problem of debt with more debt, was in the 1920s. And we know how that ended up. So we got 250 trillion and counting of global debt, which is more than 3 times global GDP. We've added debt at the rate of, depending on the country, 1.5 or 2 times more than nominal GDP in the last 10 years. So we've leveraged up the system, and maybe the burden of debt is just too great to grow. And even though interest rates are low, a lot of the debt was used for unproductive purposes, so it's not generating any cash flow. And then, of course, you have demographics, which until recently the U.S. was a hopeful spot, and now is almost as bad as others, with the population growing at the lowest rate in 80 years this last year. So if, in fact, it is the beginning of recession, it has immense implications, which is why I'm glad you asked me the question. And the first is, will the recession be over by the election? And the second is, how will this impact China-U.S. trade relations? Mm-hmm. These are very, very significant. So my hunch is that President Trump wants to run on tariffs and wants to run on protectionism and taking on China. And even if the economy were strong, he would do that. But if the economy gets weak or recession, he will double down. He's certainly not going to say, I'm in favor of free trade and take all the tariffs off everywhere. It's not going to happen.
The tariffs aren't going away.
Yeah.
No.
So that means protectionism. And then the next question is, what does the rest of the world do? Do they put up barriers? And that's probably the most important question of all, because that's what happened in the 30s, where everybody went protectionist and beggar thy neighbor. And of course, you've got some very large export economies, China, South Korea, Japan, Germany, very important to the global economy. I fear we're on a slippery slope here. And when you open up the protectionist mine chute, you can't bring it back. And there's a guy named Jude Wanniski. He's since passed away, but he was one of the original supply siders, along with Art Lafter and Robert Mundell and Bob Bartley, editor of the Wall Street Journal. And he gave me his book and wrote it to me, to Kiril, a disciple of the supply side revolution, 1978. And he wrote the book because he wanted to disprove that it was free market economics that caused the 29 crash and the Great Depression. And he plotted how the Smoot-Hawley tariff made its way through Congress in the fall of 29 and how the stock market reacted to each support or against. And finally, when it became clear it was going to happen, that's when the crash happened, or happened for real. So he makes a very good point. But having seen that and knowing that history repeats, I have this gnawing anxiety that we could be going down that same slippery slope here.
Do you think it's already gone too far? Or do you think, because you've already said that they're not going to take tariffs away, do you think it's likely to get incrementally worse? I mean, are the Europeans it already looks like the Japanese are putting up tariffs against the Koreans, I've noticed. It's not just about the US any longer.
That's right. That's what happens. For me, the arrest of the Huawei CFO on the day that Trump and Xi were meeting was the assassination of Archduke Ferdinand.
Wow.
And it's gone too far. And the Chinese have said, we're not going to negotiate or do anything until you remove the tariffs. And if I'm right that Trump wants to run on the tariffs and taking on the Chinese, that's not going to happen. And Steve Bannon, who the president has said represents his thinking better than anybody else, and who understands Trump better than anybody else, said recently on CNBC that the bid and the ask between the two sides is getting wider and wider. And the closer you get to the election, we're almost there now in terms of the calendar, the odds diminish and diminish and diminish. And then you have, for sake of argument, the Mexican-Canada trade deal, which everybody thought was done last September. I said, no, it needs to be ratified by Congress. And why would Congress ratify it? They're not going to say they won't ratify it. So, well, we have to make some changes and be some conversations. And it was the former ambassador from U.S. to Canada who said that Trump could have done this in 2017 when he had control of both houses. So in this sense, Trump's lack of experience in government and foreign policy came to haunt him because he didn't understand to do a deal like that. You've got to get it done when you have a majority in the Congress and to be sure that you maintain that because you never know about 2018 election.
And what are you picking up from your network, whether it's corporations or, over in Asia? I know you've just come back from a long trip. Are people taking this seriously? Are they realizing that maybe the world has properly shifted on its axis? Or are they still not sure?
I think there's been a realization that this is serious and they're settling in for the long haul. And one of my friends who I consider very, very smart, educated in the U.S., worked in the U.S., born in China, he's foot in both camps, believes that the old model is gone. The supply chain from China, it's only going to be the essential items that no one else can produce that China will produce for the United States. And China will be focusing on developing its domestic economy.
So then, knowing how you think, you're always looking ahead. How do you think this shifts? Where's the opportunity within that situation? There's clearly, and we'll talk about the downside risks, but I'm just always interested because you're always looking ahead and okay, if something's changing, there's going to be a winner and a loser here. How do you see that playing out?
We need to add into this my view that we're entering the cycle of from wealth accumulation to wealth distribution.
Right.
And it's as old as history. It's been going on for thousands and thousands of years. Julius Caesar canceled debt, for example. And there was a debt jubilee in the UK, I think in the 18th century. And probably in the history of man, there's never been a period of greater wealth accumulation. I don't see it as socialism per se. It's just a cycle. And if we put that into the picture here, this means that corporate profits are going to be hurt because labor is going to take a greater share of the pie. Has been going down for 40 years. So that would obviously impact the stock market. I happen to like gold a lot. Mm-hmm. It's been out of favor. It's not understood at all. People come to it very late in the cycle and they ride it up and they think they understand it when they really don't. It's a very sophisticated instrument with much different values and trading parameters than people are experienced. And I see it as the best barometer of deflation and reflation. I'm not using the word inflation, reflation. Now, at the end of the last commodity cycle, or I should say the one in the 1970s, gold and all the commodities went up because the dollar was very weak. We may get into that kind of a period. So I think right now gold is very attractive. Obviously, the mining shares are attractive. I certainly think having liquidity is very attractive. People think that there's so much liquidity and so much cash. And I've seen so many times when there's too much of something, it becomes not enough.
So let's go back to the beginning where you talked about is this a dip that we can get through by the election or not? What are your inclinations currently for that?
I'm intrigued with this concept of the Fed pushing on a string. And that's an old expression that people haven't used for years and years and years. So it's about time to dust it off and bring it back. What it essentially means is that the Fed is putting monetary stimulus in, but it's not catching. And we had this in the early 1990s after the big commercial real estate bust and the banking crisis. Greenspan kept cutting rates and cutting rates and cutting rates, and nothing happened. People were shocked. There was a lot of analysis done on why it wasn't catching. Eventually, of course, it did. I think it'd be very hard to get this started. And if you look at residential real estate prices around the world are starting to fall, and that's a very important barometer. And Chinese, of course, aren't buying. They're withdrawing capital. The Russians aren't buying. They're withdrawing capital. Brazilians aren't buying. So who's the marginal buyer here?
I don't see it.
And they're all pumped up to ridiculous prices. And what happens in these bubbles is that the excesses are so great that we get desensitized. And what would have been a single at the last cycle peak, this cycle peak, we just, okay, so it's another crazy excess, but this is normal.
Do you think that the excesses, because you mentioned the 1920s before, it feels that we're coming off that Gilded Age feeling as well?
Right.
You and I were talking over lunch about similar things, and we're seeing flags everywhere of just excesses.
That's right.
Just people are so kind of hubristic because of the cheap money that they forget that the cost of money may not go up, but the supply of money may disappear.
Exactly. Or it might not be available where it's needed.
Exactly. Exactly.
Yeah. There's this great book on the 20s called The Bubble That Broke the World by Garrett. Beautiful writer, phenomenally excellent writer. And he labels the problem of trying to solve the debt with debt. And that's exactly what we've done. Global debt is, 250 trillion, 3 times global GDP. And to get the amount of growth that we've gotten, as small as it is, we had to use much more debt than nominal GDP. So you're building up the debt to get $1 worth GDP.
And that's what worries me, because if the Fed are going to be pushing on the string, and I think we're going to learn that the Fed cannot generate inflation very easily. We're seeing inflation expectations collapsing right now. And I think, as you talk about, if the Fed start cutting rates, they'll realize they really can't shift that forward expectation of inflation. It's going to be very interesting to see what happens to debt burdens at that point, because I fear that shift, and again, something we were talking about before, is I fear that shift of the amount of corporate debt, which has doubled. All the other debt since the last recession have kind of eased off somewhat, but corporate debt has completely exploded. It's now 100% of GDP. I really worry about that. What do you think about the corporate debt situation?
Totally. That's where the real Achilles heel is. And how much malinvestment was there, and where is it? And what happens if and when it has to pay an interest rate that reflects the risk of the credit?
And what happens to buybacks if that's the case? Because it's all driven by the same kind of circle.
Exactly.
And I'm worried that, I don't know what the price should be for junk bonds, but it's clearly not what it is now. And if we see any defaults from triple B into junk bonds, then I think all the buyback stock, which is the only buyer of equities. So the whole thing is very circular, and you could have a mild recession, but quite a big market event like 2000 was.
Exactly. In the early 1980s, the name 13D, my company, comes from filing a 13D statement with the SEC. You buy 5% of a public company, you have to file a 13D. At that time, stocks were incredibly cheap because you had the big inflation. Interest rates were at 14, 15% on the long end, and you could break them up and sell them for twice or three times what they were selling. Michael Milken came along as the conduit and the facilitator, and we became the world's expert on 13D filings. And many of these companies had horrible management. They were very inefficient, and they weren't managed for the shareholder. Now we're at the opposite end of the extreme. It's the normal cycle. You go from no concentration on the shareholder to exclusive concentration on the shareholder. And that's the very nature of human nature. You go from one extreme to another. And the one thing that hasn't changed about the world is that human nature is the same. I don't care if they're machines or not. Human nature is the same.
So in terms of how risky you think the situation is right now, just to give people a gauge of how concerned you are, where is that compared to where you've been in the last 10 years?
Well, you could have said the same thing at any point in the last 10 years, for that matter, except it's just gotten bigger and greater. But now we're coming off of a 10-year upcycle, at least in the U.S., and the rest of the world is tremendously slowing down. Japan, Germany, China, UK, Europe look just terrible. I remember in the late 90s, I was one of the first to get involved in the emerging Asian crisis. Mm-hmm. And I got that right, and we predicted that it would spread to all the emerging countries and come back to the U.S. eventually. But what I missed was that it would fuel a boom in the U.S. for an extra 2 years. So that was very painful. And this is what's happened this time again. People are saying the U.S. is great, everything's fine, it doesn't matter what's going on in the rest of the world, Trump's going to get reelected, we're going to have another tax cut, whatever it is. And I've seen this movie before. And I would tell them over again, you're going to get zapped here, watch out. And the timing of it is hard to detect. And because of the way the system works now, you can't fight it. You have to be there, which makes it even more insidious unless you have total discretion.
And that's why I've always been, in this cycle, very enamored by the bond market as opposed to the equity market, because it seems to be a clearer signal.
Right.
The yield curve kind of did what it was supposed to do. Bond yields fell at the right kind of time, and it seems to be giving much clearer signals. The equity market seems almost impossible right now compared to what's going on in the global economy.
Well, the bond market is being run by humans, and the stock market is run by machines. So
maybe that's the case. So I want to talk a little bit about something else you said earlier on, is about 1995, because the market is looking in its particular optimistic way. It's like, okay, well, the Fed are going to cut, and they're only going to cut once, and it's just a bit of security, and this is 95 all over again, which is only the one time really in the last 30 years that the cycle was rescued.
That's right.
So they're betting on the low odd event.
That's right.
Why do you not think it's 95?
Well, it's a good question. So in 1994, the Fed raised rates, surprised the market. I think it was February of 94. The U.S. bond market had its worst year since 1928. So you had that. So obviously coming off of that with a shift by the Fed was going to be very beneficial. You also had, as I mentioned before, it took a long time to get things moving. And then they finally did it. And there also was a boom in Asia ready to hit. Commodity prices went up in 93. And because the Fed is looking backwards, inflation's coming back, commodities are going up, they over-tightened in 1994. So here we are at the end of a 10-year cycle, right? I just don't see that where we are now fits into that scenario.
No, because as you said, in 95, the rest of the world was super strong. It doesn't look anything like a stale end of cycle that we've got now. 95 looked probably closer to maybe the European crisis 2012, something of that sort, or maybe the strong dollar crisis we had in 2015. It feels like it's a pre-event, and this seems it feels a lot more like 2000 to me.
Yes, that's right. Mortgage rates are down, 90 basis points, but it's had no impact on housing, showing that the lack of responsiveness as one example. I think that the risk is we're going to find ourselves in a situation where the Fed starts to panic. And I wouldn't be at all surprised to see zero Fed funds rate next year. So then the next question is, well, what does that do to the dollar? And the next question is, well, how do you bet on a weaker dollar? What do you own and what do you do? Then the next question is, does Trump try to take Powell off as Fed chair, either demote him or remove him? And will these two appointees be approved? So let's assume that they are approved, and let's assume that Powell is demoted, and let's assume that the Fed is really in favor of seeing significant monetary stimulus even before things get really ugly. Do we worry about the independence of the Fed? I think we should be. We should have been all year. We should have been last year as well. I worry about it a lot. Draghi is worried about it. It's a trend. Central banks were not born independent. They became independent through a lot of hard work. And it was McChesney Martin who fought Truman in 1952. And that was when there was a degree of independence. They're a tool of government. So what happens if we see that shift? And what happens to confidence in paper money? And then what happens to the investment process?
So, I mean, I think we're seeing that in Japan, where the BOJ has become more political in its way. And I think it's very interesting to see the appointment of, or the potential appointment of Christine Lagarde, because she is a politician and a lawyer, not a central banker.
Right.
There's a big signal in that about what the next stage for Europe is, which is, we know it from Japan, as you and I both like to look at Japan as the kind of leading indicator of where we're all going, is the central bank became more political because you need to cross that fiscal stimulus barrier, because that's the next phase, is very large fiscal stimulus.
Yes.
And whether it's supporting of market prices or other things that tend to be political in Europe, maybe it's the banking system. So the question for you is, I understand the end game of the dollar collapse, but I don't see how the Fed can be looser than a Europe that has to go towards excessive monetary policy, or Japan that has to maybe go to a debt jubilee first. How do you think that through, the relative game between everybody?
Yeah, well, that's absolutely right. Do they all devalue against commodities? And the Fed hasn't met its inflation target for 7 years. And they were fighting the last war, which last time I saw that war began in 1981, and it seems like it was won pretty convincingly. Maybe there's another war you should be thinking about. In any event, if they decide that the signals from commodities would be good in terms of confidence about inflation, they might actually encourage it. And there's a wonderful story from the 30s. FDR had this advisor who said, the way out of deflation is to buy gold and get the price of gold up. All the advisors thought this guy was a kook and crazy. Well, then Roosevelt confiscated all the gold and devalued the dollar hugely against gold. And then industrial production in the U.S. rose in the next 3 months by the greatest in its history.
But how do you do it when everybody's trying to do it at the same time?
Well, I think, as I say, you just devalue against commodities.
Against commodities.
I mean, that's the investment implication. The economic implication, I don't know. I mean, how you reduce the burden of debt is only three ways. You grow yourself out, you inflate, or you cancel it, or you write off. Maybe it's going to be a combination of the three, but the easiest is to inflate it.
But I'm not sure that they can. My actual fear is they can't create inflation because of the demographics, the debt issues, and all of the other things we've talked about. So I think if they can't inflate, and the Japanese have kind of proven that you can't do it, regardless of how much you throw at it.
Right.
So then, okay, we've got to devalue, and it's difficult to get a competitive advantage, so you don't get the industrial production boost that maybe we had back then.
Yeah.
So you kind of feel like there's somewhere between some devaluation against something. The problem is right now, if you were to raise commodity prices, it's probably deflationary because it crimps expenditure for corporations and people. It's because technology is the real source of the deflation.
Yeah, I mean, that's a very valid argument. I'm thinking about it from an economic and investment standpoint. I'm not thinking about it as a solution to the problem standpoint.
Right.
And I don't think there is a solution to the problem standpoint. And there's obviously massive amount of capital that will be looking at this and become very worried and will look at what's the one asset class that's very cheap. And that's where a huge amount of hot money could soar into commodities.
Yeah.
That's what happened in 1978, 79.
And even if it doesn't go into industrial commodities, precious metals, certainly gold, just seems like the best way of expressing that view.
I think so. I think so.
Because even if they fail to do something, gold will go up with all the attempts that they have.
Exactly.
Gold has to price in some sort of endgame option.
Exactly. And it's been suppressed since 2011. So where gold is has no reflection for its true market value. It's been artificially suppressed.
And what about how China deals with currency issues as well? Because China has its own set of problems internally, and it's gone from being the engine of growth to actually being probably the opposite now. It's probably drawing away from world growth. What do you think happens there? How does that play out?
Well, of course, we worry about the amount of debt that China has. One thing that China has that is sort of unique to it is this incredible entrepreneurial class. And a lot of its growth comes from that. People think it's this big export economy. Net exports to the U.S., for example, are 1% of China's GDP. You know, they import a lot, they package it, and they send it out. And consumption now is accounting for anywhere from 60 to 80% of China's growth. And a friend of mine owns a lot of high-end malls across China. At one point, a few months ago, I said, is there really a market in all these cities of 6, 7, 8 million for Gucci's and all these high-end products? He said, Kiril, come on. I don't want to push you down, but you have no idea how big this is. So all I can tell you is the vibrancy of the consumer economy is stronger than people think. I was in China during the great financial crisis and many other places. It was clear to me at that time China wanted to move away from exporting to the U.S. consumer, much too flaky a market. So they will take what was given to them. But already from that point on, they focused on emerging countries, which they did very successfully. Africa, Central Asia, Latin America. So this is clearly fitting in with their long-term plans.
And so that transition, these things don't happen quickly, they take time. And you've got the debt problem and the kind of Chinese banking system problem and the capital flight issues. Do you think that it gets worse, or they just remain kind of at a low level and benign, stable as they kind of work through their issues? How do you think it plays out? Is it going to be part of the problem or just a side issue?
It really depends on whether China believes that having an entrepreneurial economy is essential to its future. I'm one of the people who believes that they think that. And Xi was in Shenzhen last fall and made this very clear statement, which he again repeated in his speech at the BRI summit, where there are 30-odd world leaders and 120 representatives of various countries. And everything that I see indicates that that's what they want to do. If that changes, then everything else changes. But someone told me that essentially the private sector is what really drives the economy. 50% of GDP, 80 to 90% of profits and employment. The government knows this. It needs the private sector. And the SOEs will probably become less and less important over time. We obviously have to watch this. There's a friend of mine who's a European, very bright man who does private equity in China. And he believes that China wants foreign entrepreneurs to be very successful, meaning that they'll have an edge to demonstrate that it can happen. Now, the events in Hong Kong recently is unfortunate because the very thing they're lobbying for is the very thing that may come back and zap them. So I don't know how that plays out. It's too early yet to know whether China will start to clamp down or just let this go away. But the independence of Hong Kong, I think, is an important barometer.
And do you think, therefore, that the kind of Bannonization, the Steve Bannonization of the US government and the military complex in the US, they're very anti-China. Do you think that's wrong? And is it is it going to be long lasting, or is it a political cycle and it disappears with Trump?
Very good question. I think if Trump were not around, it would quiet down a little bit, because whoever is going to win in 2020 will have a much different idea of priorities for the nation: education, healthcare, environment, infrastructure. You can't take on the rest of the world and the second largest economy in the world and also focus on fixing things in your domestic economy. So I think as a result of that, there will be a shift in priorities, and it may just ratchet down. But underneath that, there will be this ongoing battle for supremacy in technology, artificial intelligence, gene editing, battery technology, all the things that we know, military technology, hypersonic vehicles, who controls space, the battle for what I call the capital wars, which is really China trying to weaken the reserve currency status of America, and America obviously wanting to keep it. So that's where the battle is, and that's a long, multi-decade issue that will not be resolved anytime soon.
You suggested before that Trump's going to run on the China situation, so by implication, therefore, this is not going to go away for a while. We don't know whether Trump gets in or not.
Right.
But even then, we've got until the election. If he's going to fight on it, as you said, the chance of him actually letting this go away or disappear is unlikely, because if he can show he's at war, it's always good for an election, I guess.
I couldn't find anybody talking to hundreds of clients and their friends and traveling across the world in the last 11 weeks who didn't think Trump would be reelected.
Really?
Not one single person.
So everybody thinks he's going to be reelected now? Mm-hmm. Wow.
Now, I didn't ask them whether these were people who thought Trump would win. I was one of the people who did think he would win and actually won some big bets on it. And I suspect that because people were shocked that they think he's invincible when he may not be, particularly if the economy's in bad shape.
Now, the question is how can he... There's a lot of balls in the air to try and get him through, because if he wants to fight the trade war, but he needs the economy to be okay, so he needs the Fed to cut rates far enough,
right.
But maybe they're pushing on a straight... I mean, how did...
Yeah, that's right. Now, if it's a mid-cycle correction and the Fed cuts rates and the U.S. gets strong again, or maintains its strength, then, and could do that through November, that's a long time from now, then he could feel confident of taking China on without damaging him economically. But if it's not a mid-cycle correction and it's a recession with the Fed pushing on the string, then that means the economy could be in horrible shape for the election.
And then it makes it wide open for anybody.
So then what do you do? If your instincts are to take China on anyway, why not blame China for the problem? It's the boogeyman.
And then if he does win and he's won it on that, then we go into a even more deglobalization, I guess, which was the other idea. But then everybody, every nation is a fight for itself.
One hopes that the free trade deals that are being done by the EU, such as that with Latin America, such as that with Japan, TPP, which is going forward, one hopes that these can be sustained in a global slowdown or recession. That's the most critical question. I touched on a little bit earlier. Or will they too resort to protectionism? That's what we have to watch out for. I would say I'm reasonably optimistic in determination to do these free trade deals. And I was told when I was in Beijing that China and the EU have agreed on global governance standards, which nobody thinks, but the person who told me has been right on everything for the last 10 years, so I have no reason not to believe him. So that's encouraging, but we have to watch that risk. And knowing human nature, if one country is going this way and things are slowing down, it'd be so easy to say, let's put up the moat.
So what are the other signs of excess that you're worried about, that you think, this is really getting me concerned?
I worry about malinvestment, and I worry about people who bought bonds that didn't know what they bought, or that people who bought index funds that didn't know what they bought in terms of value, and they think it can only go up. And in this book, The Bubble That Broke the World, it refers to this a very astute person in 1927. He's reading the newspaper and he sees that there are 127 bonds that are listed. And it dawns on him that Americans have been investing in these bonds. And that's what caused the Great Depression on the American side, was that those bonds went bust. It wasn't the stock market crash. Only 3% of Americans were in stocks in 1929. It was losing money in the bond market.
In the corporate bond market?
Well, in this case, it was the government bond market,
right,
lending to foreign countries. There was such a desperate search for yield. I've seen this in my career. Whenever you see people desperate to buy something, you know it's going to go bad. I can't remember anything coming remotely close to this. Trillions and trillions and trillions was forced to buy many things that had no relative value. With $13.5 trillion of sovereign credit in negative yield, how can you value anything?
You can't. And what worries about this situation is the buyers are 65-year-old baby boomers.
Yeah.
You know, it's okay if you're in your 30s and you make an investment mistake.
Right.
You've got plenty of time to recover from it. But if you've made an investment mistake by taking an enormous risk, they both own equities, and as you said, mainly index funds at record high valuations, and they own a lot of corporate bonds because government bonds didn't yield enough, so they had to get on the risk curve. That's a problem.
Huge problem. Huge problem.
Because the pension system, I mean, you know, the pension system's so big, and all of those people, they're going to rely on it, and it's not going to be as much as people think it's going to be.
Yeah, and what happens if there is a big bankruptcy of some kind, and then the lenders become more concerned, there might be more out there. So when the debt is being rolled over, it's rolled over at a higher rate that the borrower can't sustain. What should the proper yield be?
I don't even know anymore.
Yeah, exactly.
But it's hundreds of basis points higher than here.
I would think so. Think so.
If the junk bond market freezes because the triple Bs get downgraded, you know, it's possible junk bond yields can hit 10% because it becomes untradeable.
Exactly.
Now, I don't know how the world deals with something like that, but it's not. It sounds far-fetched, but it's actually not very far-fetched, because normally there's a percentage of bonds that get downgraded in a recession. Just, you know, mathematically, that's how it works. But the problem is 50% of the entire world's junk bond market is a triple B.
Exactly. And marginal triple Bs in many cases.
Yeah. I'm trying to get an idea from the kind of people you speak to. You speak to a lot of interesting people. So on the hedge fund side, you speak to a lot of the legends. Are people starting to get their spidey sense that something is shifting? Or are people still thinking that the Fed might be able to save the day again? How do you think they're thinking, that group?
You know, I'm generalizing here because there's a lot of people with different views. Is that when the Fed starts cutting, the dollar will get weak, and this will be viewed favorably at first, and then perhaps not so favorably if it continues. What happens to U.S. financial assets in a period when the currency is losing its value significantly? These are all unknown. We don't know any of these things. We can only ask questions and hypothesize. And the idea that we don't call bonds risky is just, to me, staggering. 5,000-year lows, they're not risky?
And what about the corporates? You know, I know you speak to a lot of corporate clients as well, which makes it very interesting, very unique business that you have. They obviously look at the world in a different way, in a different set of risk parameters. Are they starting to sense that there is a larger slowdown and that they're acting in ways that obviously accentuates the slowdown? Because once they start realizing, they start cutting things. Are you starting to pick up that concern?
I think there's a real concern there. And if you don't have the confidence to look at the future because of supply chain uncertainty, or a further breakout of the so-called trade war, how can you invest? So CapEx definitely is starting to slow.
And what about the pension funds? They're always the last often to get the message, the memo, right? Do they understand that maybe that equities are now becoming, or corporate bonds are becoming very risky at this point in the cycle? Or are they still desperate for yield and desperate for returns?
You know, I really haven't done a big sampling, But I would think this is a very desperate search for yield.
Yeah, I guess it makes sense. If we're at maximum retirement, then they somehow need to offer these retirees a return.
I remember it was early 1990s. I was extremely bullish on bonds, as I had been since 1984, having written the book, Is Inflation Ending? Are You Ready? I was talking to one of my clients, and I was saying, the real problem, that a client that manages money for a lot of pension funds, I said, the real problem here is the reinvestment risk inside the yield book. That's the point he made, that interest on interest is a key component. So as interest falls, that goes away, obviously. When was the last time you heard someone talk about reinvestment risk?
No, exactly. So when you look out across the kind of asset classes, we talked about gold, which obviously you're very bullish on. What else are your kind of primary picks where you think, okay, this is interesting, whether it's on the short side or the long side overall?
Well, I think it's a pretty good case. Money has to go somewhere. Mm-hmm. And if you buy the argument that what's kept the dollar strong has been the number one, the U.S. economy stronger, number two, repatriation of foreign profits by U.S. corporations, and three, interest rate differential. So if you go to zero Fed funds rate, interest rate differential goes away. The repatriation is already slowing dramatically. That'll be over. So you've lost that support. Then if the dollar gets weak, capital will leave understanding that there's a capital risk just on the currency. So where do you go? I would argue you go to Europe, you go to Japan, but you also go to emerging markets, which if you look out over the next 20 or 30 years is a place to be. That's where the growth is, that's where the population is, that's where the millennial population is, that's where fintech is, that's where all the new technologies are, the late mover advantage, such as solar. You can go to solar without the legacy power systems. And I come back to what asset class is the most undervalued in the world? And it's commodities back to where they were in 1972. I mean, what can you buy at 1972 prices?
The question is for me, because I look at that too, and I look at the long-term commodity cycle, and it's clearly interesting. I still worry that the dollar's got another spike higher.
It could be.
Before it falls. And it's very difficult to know because we talk about rate differentials. Well, if the US goes to zero, well, maybe Europe's at negative 1.5. We don't even know anymore what people, and I don't know how to price rate differentials really when you're talking about extreme monetary policy. Because if the Fed go to zero and Europe's doing MMT, I don't know how to price the differential. I don't really understand. It's a world I don't really understand yet.
That's why gold
works either way.
Gold is easy right now.
And how about US government bonds?
Well, you're looking at somebody who put all of his net worth in 30-year treasuries on margin in May 1984 at 14% and held them until August 1993 when I sold them at 5.7% yield and then got back in 1995 and sold in 2001 and went into gold and oil. So, I'm just not a late cycle, end of cycle investor. I just can't do it.
Yeah.
I've been bullish on bonds all year, but I personally can't do it.
Yeah.
You can recommend to clients that you should. I can't argue that it's a good place to be. This is not for me.
Yeah. Yeah, it's different. It's a trading as opposed to a longer-term investment position. Right. What do you advise client in equities now? You'd, I guess, be suggesting that the risk of this recession is reasonably high, so in which case we need to be cautious of equities? Or do you think central banks stop equities going down?
I think there's no evidence that anybody can give me that we aren't in a global bear market.
Yeah. But everyone says, well, the US is at all-time highs.
The longer the top, the January 2018 high had the most momentum. The September 2018 high had the next best momentum. The early May 2019 had the next best momentum. It looks to me like you're running out of momentum. Have corporate profits peaked for the cycle? I think it's good evidence that that's the case. Minefields all over the place, surprises. Look at BASF came out. Things are so distorted by the machines, and markets don't discount anymore. At least the equity market doesn't discount. Think about how difficult that is. It used to be you could buy an asset a year or two in advance, confident it would go up. Now.
But then does that also not mean that because the machines don't care if they're long or short in the end. So once the trend changes,
Right.
doesn't it drive the other side to extremes too, potentially?
Absolutely. And that's what we saw in China in the second quarter of 2015. The algos drove it up and the algos drove it down. So we haven't seen the selling on the downside.
No.
We've seen little bits and pieces of it. We've got kind of a sense of it.
But I find that when I talk to people, what happened in November, December kind of proved to everybody in their minds that the market can't go down. Even though, as you point out, every time it does this, it goes on, the breadth is not as good or the momentum's not as good. There's a number of red flags, but everybody says, see, the Fed won't let it. Donald Trump will not allow the stock market to go down because he cares about the stock market. I've not seen somebody omnipotent versus the stock market. They may be able to manipulate it somewhat, but I have a feeling that there is larger powers at work than...
Oh, I think so, for sure. For sure.
And because I remember this very, very similarly in 2000. If you remember, the whole of 2000, the stock market thrashed up and down, made marginal new highs, went back down again, back up again, and volatility at the top of the range started rising and rising and rising, and that was the kind of signal. And we're seeing similar things now with the market thrashing around in a large range, keeps breaking to new highs, then rolls over again.
Yeah.
The similarities are extraordinary to me, this big, broad top pattern, potentially.
We've had a secular peak, or if you want to call it, at the last year of the decade for every cycle. 29, 69 in equities, 79 in commodities, 89 in Japan, 99 in tech. I'll give you 2008, okay, it was a year early.
Yeah.
And it was probably because of the Fed.
Well, they finished in 2009, so that's good enough, right?
So here we are. I mean, it's just, everything is falling into place here.
So 2019, what is it, the death of the corporate bond market? Is that the big shoe to fall, you think? And everything else is kind of a construct around that?
I was talking about this with a friend. What would be the catalyst? And I reminded him that it was Roger Babson, not that I'm making a comparison at all, but Roger Babson, who set off the crash of 29 by saying, I'm going to remind you, as I have for the last 2 years, that one day there's going to be a big crash. What was new about that? And bingo, there it was.
Yeah.
So it'll be something that we can't imagine.
Because even when you go back and look at 2007, 8, it's not clear what the events were because there were lots of small events. And looking back, you can say, oh, well, obviously it was when Countrywide, or obviously when that BNP money market fund got into trouble, or whatever it is. All I'm seeing now is I'm noticing the Neil Woodford fund in the UK with liquidity problems.
Exactly.
I'm noticing the H2O Natexis fund with liquidity problems. I'm noticing the GAM fund that had liquidity problems. I'm seeing liquidity as an issue in various places where suddenly people want their capital out very quickly. And you and I both know we have a big liquidity problem.
Big liquidity problem.
All around the place. So if I was to say there's something, it feels like the butterfly's flapping its wings, that may or may not cause the hurricane in the future, but it just feels like it's there.
Yeah, no, I think that's a very good. When we look back on it, you'll see, in retrospect, all the little signs, just as you mentioned. And as I said before, we become so desensitized, and it's gone on for so long, and it could have ended at any point in the last few years and didn't. So therefore, why is it now? 2020, 2021, 2022. And, was it Prince City, the music's still playing, I'm still dancing?
That's right. And then suddenly it stops. I think it's going to be a really fascinating, maybe 5 or 6 months. We'll probably know one way or the other whether we're going into something worse, some more recessionary environment, which, I think both you and I are looking for that equity market top. I'm also a big believer in gold at this time as well. I think we've got different views on the dollar in the medium term. In the long term, I think we both completely agree. We'll wait and see how it plays out, but it's going to be a really, really interesting time. And I think the key message from both of us is you just need to be really cautious here. This is not the time to make assumptions. And I think a lot of people are making assumptions all around us about this time it's different. The Fed's got your back. Donald Trump won't allow that to happen. Donald Trump's definitely going to get re-elected. There's a number of really big assumptions the market's making. Tariffs are going to go away.
Exactly.
All of these things. There's some really big embedded assumptions that I'm not sure are built on strong foundations. And because there is a change in the social, I don't know whether it's the social contract, there's something that is changing that you and I talked about again over lunch that makes you think that things like corporate buybacks will get stopped at some point, because at some point people are going to say, but why is the management getting rich and the workers aren't?
Exactly. It's just, you had what, 5 trillion of corporate buybacks. I think 25% were financed with debt. Balance sheets have been run down. And if it turns out that those were bad decisions and that they bought their stock back at too high a price, there's this great quote that Peter Drucker has, which is the heroes in the boom become the villains in the bust.
So who are the most likely heroes now
Well,
versus the villain?
I think we can all just guess who they are.
It's a really pivotal moment in time. And I like you, have a sense that there is a secular turning point within this. I'm a big fan of the book, The Fourth Turning,
Yes,
Neil Howe book.
I am too.
And it just feels like we're at that fourth turning
does.
moment. And I don't know how long that transition takes,
Right.
but I just feel like it's coming. So
No,
we'll
it
wait
is.
and see.
I agree with that totally.
Perfect. Kirill, thanks ever so
thank you.
much.